So the methodology for this portfolio is to get an initial dividend yield of more than 4%. If we aim for too high a number, we're just really stretching for it, and that can lead to disaster in terms of some poorly performing funds and potential dividend cuts. We need dividend growth of 3% or more over the last 5 years. That means that the dividends are keeping up with the pace of, well, what used to be normal inflation. They need to be uncorrelated assets, so they won't fall heavily at the same time. There might be some fallen angels in that portfolio where the price has declined, dividends remain the same, and so we've got this yield opportunity that we can capitalize on. We're going to check the dividend policy. Some of them are percentage of net asset value, and in doing all this we'll create our own annuity that pays us an income that hopefully does grow over time. So I don't invest in individual companies because, as you can see in this example for Direct Line, they can just end up cancelling a dividend altogether. You're not really sure what to do because the share price has bombed out. You might continue with it, you might not. If you did continue with Direct Line, it only went on to fall further. Living off dividends can be tough. You really need to backtest your strategy. This is the ETF IUKD that has the 50 highest yielding companies in the UK FTSE 350. The highest ever dividend it paid was way back in 2008, and it still hasn't paid a higher dividend than that of 2018 in recent years. So here are some asset classes that you can use when you're investing in investment trusts. So you've got a wide variety. You might want to pause the video, just make a note of them. So now we can also have a mix of the portfolio where some will be high yield but low dividend growth, and then some are lower yield but a higher dividend growth. And the mix of these, that blend, will enable us to get the 3% dividend growth and the 4% yield. So I'm now going to look through some different asset classes. This is just equities here. We've got the names, we've got whether it's a discount or premium to the net asset value. That means is it selling for less than it's ideally really worth, what the dividend yield is, what the payout is, how that's grown over the last 5 years, what the dividend policy is, and the 5-year total returns. So I look through all this, try and find ones that I like that seem to have a decent combination. Where the growths are very high, I just tend to think that, well, it might be that they've changed the dividend policy. I mean, that's not really sustainable. The one to look at here is Henderson Far East, so 9%. People might think, well, that's great, and the dividends have actually been growing, but the total returns over 5 years are only 3%, and that means that the value of the underlying equity has fallen over time, which isn't really that great, and it's not really what I'm looking for. I'd rather go for something like JP Morgan Global Growth and Income, 80% returns and a 3% yield. This is private equity. What we notice here is that there's a negative correlation between the total return and the yield. So the lower the yield, the higher the return, which is interesting. Their dividend policies are to pay out a certain percentage of net asset value, currently on quite a strong discount to net asset value. That's because some of the asset values are a bit out of date, and then people lack confidence in how these companies are actually valuing their assets. But actually, these investment trusts invest in some more mature companies that are run as cash cows. They are quite cash generative, so they're very different from the more venture capital end of private equity. I'm going to put a link to my private equity video in the description, and I'll put a little caption at the top here so you can understand it a bit more. So one private equity company is Peters Hill Partners. I think this was spun off from Goldman Sachs. So the people that run it, are they these like Tefal eggheads? They're just geniuses and you should back them to the hilt, or are they just complete con men trying to rip you off? Well, the track record at the moment is short-lived and not very good. It's a little bit difficult to decide, so maybe put a comment and let me know what you think. Next up, we've got infrastructure. So this BBGI, it's at a premium to assets. That's because it's felt that this one has the greatest linkage to inflation, so it's potentially more protected against inflation. But IMPP and HICL are at a discount to net assets, and they've got a good yield, so they're probably worthwhile considering. Now we've got some solar funds and also this JLEN environmental assets, and again, as the yields go down, the total returns go up, which is interesting. Maybe it's just a coincidence. These ones, fairly limited dividend growth, unfortunately, but pretty good yields. Now we've got property. I'm not really a big fan of property. So we've got urban logistics and TR Property. TR Property invests in other property companies such as Segro, and urban logistics is just warehouses. You've got the returns here and the yields here. So TR Property, I mean, it was a star performer, recently not done so well, and a bit difficult to say whether it will go back to performing well again. Now we've got some debt investment trusts. New City High Yield, that's a favourite of John Barron. Reasonable returns and a good yield, but you are paying a premium for it. So these hold things like, it's just corporate debt really, and some of it is being redeemed, so it's maturing, and then they're purchasing newly issued debt to replace that. So the yields will change over time depending on how corporations are issuing their debt. So that's why you've got like a negative dividend growth here. Next up, we've got the more miscellaneous end. So we've got song royalties, potentially interesting. We've got world mining, but if this is on a premium to net assets, it's just quoted companies. So that's saying that there's a bit of excitement around mining at the moment, and it's probably best to buy this one when it's out of favour rather than whether it's very much in favour, even though the returns have been good. So we could get some mean reversion here, or maybe we're at the start of another commodities super cycle. International biotechnology is interesting if you want exposure to that area, and then you've got the dividend policy here, so you get a reasonable yield and then potential growth, although it's been a bit elusive recently. We put all this together and then I put it into a spreadsheet, and this one looks at compound growth rate of the share price, so sometimes it's negative, how volatile it's been. Then we look at the Sharpe ratio, which is just comparing growth and volatility. Look at the maximum drawdown that you would have experienced, so it can be as high as 55% BlackRock World Mining, although quite a bit lower with some of the infrastructure and also with JP Morgan Global Growth. The duration of the drawdown in terms of the number of months, and then we've got here returns over maximum drawdown. I then rank all this, give it some weightings, give it an overall score. I've got some past criteria here that says, well, I want like maximum drawdown duration to be 36 months or less. So from this past criteria, I've now screened some of these investment trusts, and it's given me some ideas to analyze further. So this spreadsheet is for sale on my eBay. I'll put a link in the description. And then the second file that I also sell in the bundle on eBay is this one. So it's looking at 10 assets, looking at the correlations between them, because I want things that don't all move at the same time in the same way. And then it's also again looking at some of the returns, Sharpe ratios, returns over maximum drawdown. So I put all this in, build a portfolio from it, try and find some of the best ones that I like the look of, and then I can compare it against a global tracker. So here what we can see is that the income portfolio has been pretty robust in terms of price, but it hasn't grown, whereas the tracker has been quite a bit more volatile. So if you don't like volatility, then this is working quite well, although to be honest I have partly selected on lower volatility, so it's not surprising. We've got a maximum drawdown here of about 8.5% compared to 16.5% for the tracker. This portfolio has a yield, I reckon, of about 4.9%, dividend growth about 3.8%. So I've made my objectives, and then what I can do is just play around with the weightings of the holdings, and then now I've got sort of closer returns to the tracker because I put more into the JP Morgan Global Growth and Income, and then the yields come down a bit, the dividend growth's gone up and the volatility's gone up as well. So I can use this tool to help me put together a portfolio and really stress test it and back test it and see what I think. So I hope you've liked the video. Give it a thumbs up. Let me know your comments. What would you put into an income portfolio? And I'll see you next week.